especially the medium and smaller players have seen very little transaction volume. They're impatient.
Okay, let me ask you this. Have we seen the bottom? I mean, we got CMBS stuff coming up till 2015. We still have unemployment issues. Where are we at?
My biggest fear about what could fundamentally change it is continued anemic job growth or no job growth,
Right.
resulting in structural unemployment and putting us at risk for actually a deflationary cycle. The Fed seems to be managing that well.
Mm-hmm.
So if we set that possibility aside, we have seen the end of any systemic banking risk or real shock risk to the financial system, and we are set up for a very slow recovery.
Okay.
Now,
so
with real estate, the number of loans that are going to go into default will be far greater in the next 2 years than were in the last 2 years.
We're talking residential now?
No, we're talking commercial.
Oh, okay.
And the thing that comes after that, which is property foreclosures, we are really just beginning that in commercial.
Okay. And so, and you say it's really coming up. So, but the systems are in place to move this property and keep things going. So you're not seeing the death in the prices and the values at that point, or second bubbles occurring?
There will be price pressure, downward price pressure on especially B and C quality smaller commercial assets,
Right.
because there will be a lot of foreclosures of those kinds of properties. For instance, every time one of these large-scale portfolios sells from a bank to one of my customers that we're financing, what they will do over the next year or so they will foreclose on those loans. And as soon as they foreclose on those loans, they will sell the property, put it on the market for whatever it's worth. Those guys are not
the market will bear at the time.
Whatever, and if that's a low price, which it probably will be.
Right. Don't we have a move to A properties since everything's so cheap now?
The difference between,
expensive, I should say.
because of the foreclosure pressure, which will depress prices of lesser quality properties, we're going to see for a few years a larger than usual price difference between the high quality trophies and the B's and the C's. Because that phenomenon generally won't be happening with the high quality trophy properties.
Right.
So they won't have the pressure on them from a lot of comp sales of distressed foreclosed properties. The B and C properties will have that pressure.
Okay, so people say things are easing up a little bit. I know you have money to lend, obviously. Criteria is a lot tougher than it was.
Well, first of all, yes. 2010, there was very little liquidity in the banking system. There were not many folks making loans, and we were different in that respect. We're not going to be so different in 2011. A lot of our traditional competitors are back in the market. U.S. Bank, B of A, PNC. They were only mildly or not in the market at all last year. And so there's definitely going to be more liquidity in the system, which is good for the economy. And as far as it being tougher, leverage is less than it was at the peak, but it was irrationally high at the peak. So the fact that you can't get 80% senior debt leverage anymore, you can only get 65 to 70.
Right.
And the fact means that you need more equity, which means that if you're one of those investors, you're probably going to need to get more equity from your financial partners, which might be a private equity fund, it might be a group of investors. And all of those investors want a return on their money. So your entire capital stack, you have less of the cheap bank debt and you have more of the more expensive equity. So your capital is costing you more. And as a result of that, you just won't be able to pay as much for the property.
Right.
But that's true for every investor that you're competing with. So the fact that, but your deal will still work.
Okay, because I've also been told, we all know the commercial properties, for the most part, the lending was always based on the property. People are telling me all the time that the banks are asking them for their tax returns and their private.
Yeah, at Wells Fargo, we have a 3-part hierarchy of lending in real estate, and the first level is always people. It always has been. It hasn't been the real estate. Even in our non-recourse lending practice, number 1 was people. Now, in that case, it wasn't the balance sheet of the people, although we like people to have capacity and access to capital, but they weren't signing a repayment guarantee. But we still want them to have integrity, track records, those sorts of things. So for us, our people filter in 2009 and 10 has not changed from the way the people filter was in 2004 or 6 or 7. I've been with the bank for 25 years, originally at Wells Fargo, and the merger with Wachovia was a complete game changer. A hugely positive thing for us, and frankly, compared to the alternative acquisition for the people who work at Wachovia, it was a big positive for them too.
Right, that's good. Did you get all their bad stuff, all their bad stuff?
Yes. We inherited a balance sheet real estate portfolio of equal size to our own, and 80 to 90% of it was distressed. It caused us to reorganize the bank and to form a massive workout group just to manage that portfolio. It was close to $40 billion worth.
Wow. Okay, we got people out there that say, here's the managing director of Wells Fargo, so he would probably know when I bring something to the bank that I want to get a loan on, what am I looking at besides having having money in skin in the game? What kind of deals you guys looking for?
We're looking for to establish relationships with good, skillful people in this business, and our job is to support them in every way, making loans, providing banking services, and all of that. And what we have built this company on is just by making people successful. So come to us with a plan. Show us what you've done before. Show us what you propose to do and how you propose to do it. We've got a lot of very experienced people like myself who can evaluate that, maybe make suggestions, but that's what we're looking for.
Great. Do you have any questions?
I'm just curious on interest rates that you're offering on these properties. What kind of indexes are you tied to, and what are your overall rates?
Our balance sheet lending portfolio is basically LIBOR index-based, floating rate. There are ways to fix rates with swaps, assessments, and so forth, but it's simply a floating rate LIBOR-based book of business. And credit spreads on top of LIBOR. We do both recourse and non-recourse. So recourse spreads are of course lower, generally in the high 100s to maybe 300, depending on the leverage of the property. And non-recourse spreads generally are 100 to 150, maybe even 200 basis points higher than that. But with floating rate indexes at historic lows, even a distressed asset loan with a 500 or 600 basis point credit spread is still less than 6.5% interest.
Right.
So it's, you know, and if purchased properly, a distressed asset acquisition should be a high-yielding investment. So, you know, you don't need to get very much of that cheap debt in order to really leverage your investment very effectively.
And you may have mentioned it, you do regular loans, you do mezzanine or any?
We do some junior loans, yes.
Okay.
Yeah.
And what, any other?
Between our group and the other offerings in Wells Fargo, there's quite literally nothing in the real estate capital stack that we cannot provide, including, as we said before, we have a group that is doing preferred equity, true equity investments at the project level, and that will result in leverage overall leverage up to like 98%.
About construction loans. Tell me about it. Are they up, they down? What's going on there?
They're much less than they were, but there's some good projects out there, and my office has actually 3 ground-up condo construction loans underway right now.
Oh, okay. Since 1984, the climb in commercial real estate's been 8%. After the fall, MIT and Real Capital Analytics repositioned it even before hitting median.
Yeah.
That was going to be 3% for quite a long time. Is that where you see things are better or worse? Or?
What's interesting about, and I've been in commercial real estate for 33 years.
Okay.
There is no normal time. Every 6 months is different than the prior 6 months. Mm-hmm. Rates go up, rates go down, prices go up, prices go down, so do rents, vacancies. Mm-hmm. All of these things are always in flux. And it's my observation that people can make money in all of those environments. Right. And some people lose money in all of those environments. It's a mistake to think that you need high growth rates of anything in order to make money in commercial real estate.
Is that you know, in fact, if somebody was telling me earlier, it's like, you can make money in this market, just don't try to be hitting out of the park all the time, like a couple years ago. You know, be very direct, be very focused on what you want and what you're trying to do. And
you know, commercial real estate has always over the long term, has always rewarded people who are skillful and disciplined. The disciplined players tend not to be the ones who are reaching for far opportunities.
Right.
You know, the most successful people in commercial real estate aren't the ones who hit a home run or two. They're the ones who just consistently hit doubles
consistently
and
and persistently. Right.
Yeah.
There you go. That's the name. Raymond, thank you so much. It was a pleasure to have you here today. Great interview.
Thank you.